Today's part with the following interruption for a public service announcement.
Welcome to Investing in Intelligence, where we talk about artificial intelligence companies, stocks, and trading. I'm James here with my co-host Kai, and today we'll be talking about the top 3 AI stocks that you've never heard of. I want to remind you that the opinions expressed on this show are just that, opinions. They should not be taken as specific advice to invest in a particular way. So, Kai, I think you just mentioned that we had a comment on one of our short videos. Somebody saying that we're wannabe amateur analysts or something like that on the Apple video.
Well, I think the point was valid, and I would provide some clarification of what you meant by no growth. I know what I meant by no growth in regards to Apple as a company over the last 3 years, but essentially the critique was you were arguing that Apple has no growth, zero growth, and I think this particular comment was critical of that. So, what is your response to that?
My response is that since literally everyone in the world owns Apple, everyone in the world will be angry if you say anything negative about Apple. But to me, that's not an excuse to lie. So if a stock or a company has issues just because I own it or you own it or everyone in the world owns it, doesn't mean that I'm going to paint a rosier picture than the picture that is reality. So I do think Apple has the ability to grow. Obviously, I bought Apple. So if they had listened to the full episode, they would have heard that despite my negative comments on the very clear and obvious lack of growth over the past year or two, I did just buy it because I think that we're going to have a really good upgrade cycle, iPhone upgrade cycle, especially from this AI stuff. But they have been kind of rolling back their AI announcement. So they've been gradually saying, no, it's going to take more and more time. And if you read the fine print, it says a lot of the features aren't coming out until late 2025 anyways. So I actually don't know how much of that we're going to see. Not to mention in China, apparently, we're not going to see as much of their new AI software stuff in China because they don't even have a partner lined up for that yet, like they do ChatGPT in the US. So to be honest, the stock has pulled back a bit like everything has. But overall, I would say maybe the bump in the stock was a little bit too much initially.
Oh, I love the bump. I have a large position in Apple. I want to say James and I both, we welcome both positive comments and negative comments. I mean, one of the reasons why we started doing this is to learn, especially learning from our mistakes. I think you can learn a lot more from your mistakes, especially in regards to trading or investing than you do your wins. I think sometimes your wins can provide sort of a false sense of security. So, to our followers, listeners out there, please, throw it at us. I mean, I love that. And so I think
we love negativity.
Question. Well, I'm a glass half full type of person. James is always the roses smell good on the other side of the mountain type of person.
I don't even think that's a saying.
It's not. I just made it up. But the one thing is, so thank you out there for the critique. Give us more. I love it. I love it. So I always will throw those questions at James, being that, again, he is wrong 45% of the time. But one of the things that we were trying to paint the picture with Apple is that the EPS has been fairly consistent and not had the growth that other AI companies have had. The revenue growth has not been there like in NVIDIA. That being said, Apple has something very powerful, and that's their devices are integrated into the aspects of our daily lives in which we use them on a daily basis. They're very integrated. The software is very easy to use, and they're poised to be a big player in regards to AI in the future. And that's my opinion on that. So,
yeah.
All right. So let's jump to, everyone has heard of Apple, James. Everybody knows Apple. We've talked about some companies on this podcast, and then we're going to talk about companies that are very popular. Everybody now knows NVIDIA. I mean, 3 or 4 years ago, I never would have heard of NVIDIA or knew about NVIDIA. But let's talk about 3 companies that you may not know. So let's start with just one of them. We're going to go through 3 of them, but give me one company that may be one to look at in regards to a AI build out play.
Absolutely. And first of all, I should just preface and say, if you continue this running joke of James being wrong at the time, it might be bad for subscriber growth. But transitioning to the 3 AI stocks that you've never heard of, the idea here is that everyone's heard of the big ones now, TSMC, ASML, even some of the second tier ones like Micron, Applied Materials, AMAT. So people have heard of most of these so far, but there are still a lower level, and usually they're smaller cap companies that people haven't really heard of yet. Some of these have already seen their stocks blown up, like Vertiv and Coherent. Some of them really have low valuation still. So the three that we're looking at today are Coherent, Axcelis, and ASC Technology. Coherent has had a bit of a run up, but Coherent, just to give you the outline here, they design and manufacture transceivers. So that moves data between AI servers. They also make products to create AI chips. So we're talking lasers that cut and engrave the AI chips. Um, More often, though, their tools are used for powered chips like those in cars, so computer chips that go into cars, but they are used by companies like TSMC and ASML. So actually, one of the lasers they make is apparently used to make the OLED screens that Apple uses in their iPhones and their Apple Watches. So this company is central to the overall supply chain of chips and even displays. Now they do have some competitors. Corning and MKS are competitors, but it seems to me that Coherent is the most AI centric company amongst those three. So if you really want an AI play in this space, I would go with Coherent. Now, on the financial side, they've got a 24 forward PE. I put an optimistic price target of 90 on it, which is 26% upside from the current price of $71.60. The major risk I see is just that the stock has already run up 62% over the last 6 months. So this one, a lot of people still haven't heard of this one, but it has gotten a bit of the AI bump on it.
Is this more a true utilizing sort of the end product of AI, or is it more part of the build out? Because my understanding in looking at this is a, a build out aspect of AI.
Yeah.
Other big players will utilize these lasers, et cetera, or some of the products they have to build out some of their chips. Is that correct?
This is an infrastructure play. This is an AI infrastructure play. And actually, all three of these are AI infrastructure plays. When it comes to what you call either the build out or like the application layer of AI, application layer is probably more in its infancy than the infrastructure side of things. The infrastructure is largely still in place. So this is an infrastructure play on AI, and they are pretty diversified. So they do lasers that go into defense equipment too. So it's not like they're just doing AI stuff, which can help with a potential pullback in AI coming 3, 4, 5 years from now. In my opinion, never, but it is possible that at some point, all the companies buying the AI chips might slow down their purchases. So that is a possibility.
Well, in the application layer, we may see some busts. However, we are in the build out of AI. I mean, these servers are being built. They're clearly ordering GPUs, chips, and that's why we've seen the revenue growth we have. And so that's one of the reasons why James and I wanted to highlight. And James is talking about these three companies in particular because I think they're all build out in regards to the build out phase of AI. I will make a quick comment, and even though I won't harp on you any longer for the 55% being right, I will say, James, that you are right more than CNBC. I mean, if you want to get on and they're behind the eight ball. I mean, in my opinion, a lot of these, when you watch a lot of these large news networks, they're behind the eight ball. And so they'll advertise, hey, we're here to make you money. However, I distinctly remember Jim Cramer just loving on McDonald's right when McDonald's is about to hit 300. And McDonald's is at a way below its 200-day moving average. So a lot of times, once these companies start to make the news, it's already too late. We're already too late. And one of the things that we could have done better initially, we talked about energy as a play long before we did a podcast. And we both of us had talked about, hey, we should do a podcast on energy earlier than that. I mean, we were both in energy plays prior to doing the podcast. But these three companies that we're talking about today are strictly involved in the build out phase of AI, which I like the ones we're highlighting here. So one of the ones that I really liked in regards to the financials was Ace Tech. So talk a little bit about that one and how they're different than Coherent.
Yeah, Ace Technology, or ticker symbol ASX. So I actually really like this one too. This is probably my favorite of the three. So they do semiconductor assembly. You could also call that packaging, and they also do testing. So they're an external or outsourced packaging and testing, chip packaging and testing company. And their customers are like the who's who list of these chip makers. So AMD, NVIDIA, Intel, Also, Apple, Qualcomm, Broadcom, Sony, Samsung, everyone who's big in chips and also memory, they're working with Ace Technology. So TSMC does some of their own packaging and testing, but they still need Ace Technology for packaging because they just can't do it all themselves. Not to mention, there is a competitor called Amkor, and they're headquartered in the US. So I actually like Ace Technology for being in Taiwan a bit better. They're more central to the chip making world. They have better existing partnerships with the major chip makers. Not to mention, they just have the most advanced and comprehensive technology offerings for packaging and testing. So I really like this company. Their forward PE is 19. I had to do some math on this. By the way, all three of these companies don't have as much analyst coverage. There's not even a Morningstar report. So Kai and I really had to do our own research on this stuff to come up with info on these because there is no major analyst coverage of these stocks. Rarely even you see a news article on something like Ace Technology or the next one, ACLS, Axcelis. Anyways, so yeah, forward P of 19. I put an optimistic price target of $16. That's a 35% increase from the current price of 11.87. So that's end of next year. I just want to specify that's end of next year. So I'm using next year's projected earnings. So like a year and a half hold, I'm hoping for a 35% upside on this stock. The only major risk I see is they're in Taiwan, but I don't know if that's an excuse anymore. Some people want to give a lower PE to a Taiwan-based company. I personally
Right.
don't.
Well, I mean, TSM as a company is one of my favorite companies. Do you see the amount of business that some of these companies are doing with China in particular? I think it was Coherent as a threat to, in regards to geopolitical concerns. A U.S. based company doing the majority of their business in China as part of their potential risk for some of these companies.
It depends on the specific company and how much of their business is China. We've talked about companies in the past that have a huge percentage of China. I don't have the number for Ace Technology or Coherent, but I do have the number for the next one we're going to talk about, which is Axcelis Technologies, ticker symbol ACLS. 50% of their sales do come from China.
Well, and that's what I wanted to segue to, and I want you to talk about the next company. I also want to point out, just in general, for some of the basics. So, someone's risk tolerance in regards to their financial income, how much money they have to invest, the age of the individual, whether they're closer to retirement, they're younger, is different. And so, depending on your risk tolerance appetite or the amount of money you can be aggressive with, that may be how you allocate money. And I think one of the three things, really, or really, let me go with two that I see as the highest return on your investment are cryptocurrency and AI right now. I don't think you're going to get a higher return on your investment through anything. Maybe real estate. However, real estate comes with a significant amount of risk, and especially on how high interest rates are and how high real estate is right now. But I will say these are AI plays that are even lesser in evaluation. I mean, a company like Ace Tech is you can buy more shares with a huge potential upside if the build out phase of AI continues. And so one of the basics, one of the reasons why James and I want to highlight these plays is that there's potential right now. It's happening. The build out phase of AI is happening, and the returns on these investments can yield you a lot more money than if you were to say buy Procter and Gamble or to buy other companies or just to in general buy stocks, bonds, other forms of investment. AI and cryptocurrency. I can't think of any other of my top two that you can. I don't know if you want to say get rich quick, but really right now the returns, we've never seen these returns in a long time.
Yeah. So for cryptocurrency, I wouldn't necessarily couple it with AI stocks just because cryptocurrency has no fundamentals. So how do you value a cryptocurrency? They try to use the digital gold argument for Bitcoin, but it's hard to value a cryptocurrency. Real estate supposedly has actually the lowest risk of all investments, or maybe bonds. Bonds and real estate, maybe there's similar amount of risk. It just, everything depends though. Like bonds haven't performed well over the last year. Real estate has performed well, but look at commercial real estate. Commercial real estate has dropped off in value. So it's just everything matters so much on the details. What I will say is, I feel like if you have a really well established company, even if it's an AI stock, your downside can be limited. And what you just mentioned is key. You just mentioned if they have a fair valuation, your downside is limited. So what we're doing today, especially two of these three, have a pretty fair valuation. The one we just mentioned, ASX, ticker symbol ASX, ASE Technology. The next one, Axcelis Technologies, ACLS. These two especially have very fair valuations. So you don't have to be as worried with them being established companies who have an important role in the chip making supply chain and have a fair valuation. You just don't have to be as worried about a huge downturn in these stocks, a huge pullback. I think that's one of the reasons why we're talking about it right now. You hear a lot of people in the market talking about pullbacks in the market, 5%, 10% pullback in the market. Well, if you're holding a stock that has a 70, 80 PE, it's a software company, it's run up 60% in the last 6 months due to AI. That's a scary thing to be holding going into a pullback. But let me go ahead, unless you have something to respond to on that, I'll go ahead and go into ACLS.
No, I want to talk about ACLS. Yeah. So one of the things we talked about is ACLS is in the United States. Ace Tech is centered in Taiwan, although they have headquarters around the world. I think Coherent is in the United States as well, correct? But
Correct.
ACLS does a large portion of their business with China. And so that's why I was bringing that up. 40%, I think you mentioned. So go ahead and say what.
So it's 50%. And it's not just that they do business with China. The risky thing is that they are an American company that does business with China. So the US government has a little bit more leeway to grab them by the arm and coerce them to potentially put restrictions on sales to China. I do fear that ramping up if Trump comes into the presidency, because he's already talked openly about tariffs. And I don't think Trump could put the blanket tariffs that he wants to put without having a negative impact on the economy and causing more inflation. So he'd be more likely to do targeted tariffs, maybe towards their AI purchases. Anyways, going back to the basics with ACLS, they make ion implantation machines. Ion implantation is a crucial process that must be applied to a silicone wafer to make it into a computer chip. Okay? Now, their customers are once again a who's who list here. So Intel, Samsung, TSMC, SK Hynix, Micron, who's who of the chip makers and memory makers. They do have a major competitor in Applied Materials, but understand the difference. Applied Materials is a general technology semiconductor equipment manufacturing company, whereas Axcelis, ACLS, focuses only on ion implementation. So in my opinion, Axcelis has better ion implementation machines just because that's what they do. That is what they focus on. So they have a forward PE of 22, and I put an optimistic price target of $208 for the end of next year's earnings, which is 49% upside from the current price of 140. And the major risk I see is just that 50% of their sales come from China, but that is a major risk. Now, I have to give one disclosure. I have held a small position in Axcelis, very small position, since May 10th, and I'm already up 23% on my position since May 10th. So this one is starting to catch on, but I do still see potential significant upside on this one.
Do you like baseball, James?
Not really. Where did that come from?
I was going to use a baseball analogy, but we won't even go there. It's okay. We won't even go there. But batting average is getting better. James has hit a home run out of the park, home run with ACLS. One of the strategies that I will say for listeners out there, and the internet has changed this, substantially. And you can get on these companies. Part of the way a company becomes public is that their financials are reported each quarter. And so in regards, one thing we know is that a build out of AI servers, AI companies, applications is occurring. And when you see companies, and one of the things James keeps mentioning is companies like Apple, NVIDIA as customers, that essentially the demand is there for a company like ACLS or ASX. And so you can put this on a watch list and you can watch it very closely. And when their earnings calls come out and their financials are reported, and you see particular, for example, you may look at net profit margin, you may look at EPS, you may look at revenue. You see good numbers with these companies. That's when you go ahead and say, okay, when I have a good evaluation and a forward PE, explain why forward PE matters and current PE when you're looking at these companies, and why you keep bringing that up. For our basic listener out there, for example, ACLS is at 140. You're given a price target of 200. Why does a forward PE matter?
Yeah, I mean, so for a company that's rapidly growing, I prefer to use forward PE, and keep in mind what they call the standard PE. The PE ratio is actually a trailing PE, and it's looking at the last 4 quarters added up. But if those last 4 quarters were a lot less revenue, a lot less earnings than what we're seeing in the future, investors are going to go ahead and shoot up the price of the stock because they're expecting so much more for the future. And then when you compare the current price to those last 4 quarters, it looks like the PE is super high and it's just out of control. But that's because investors are taking into consideration the next 4 quarters, not the last 4 quarters. And the next 4 quarters are going to be way higher. So for a company that's growing rapidly, I prefer to look at the forward PE, not the trailing PE. It's a more accurate measurement. That being said, I think you and I need to start looking at discounted free cash flow and also the free cash flow multiple. Because today, when I was doing research for these 3 companies, once again, there's no Morningstar report, which is kind of my go-to source, my go-to guide for everything on a company. So I had to go to YouTube and I had to hit all these videos of all these little CFAs and financial advisors who make all their little videos. They all get like 300 views on videos. There's like 4 or 5 dudes who make a video on all these little companies. So a lot of these people are doing free cash flow metrics to determine valuation and discounted free cash flow. So that's something that eventually we should start looking at. I like PE. You know, I love PE, but I think we should start looking at free cash flow as a way of valuing companies eventually, and that might be beneficial. But most people who are investing, most retail investors, it's just like they need like one metric, you know, like having all these different metrics and numbers. You're moving past the novice point and getting into amateur, not professional, but you're getting into more advanced terminology and more advanced required knowledge once you start adding on all these terms. And that's why I don't really like doing it. So I'd like to know your opinion on that, Kai. Like, do you think we should start talking discounted free cash flow model and all this stuff? Or
I think there's a couple aspect of it. In a company like Apple, that we've talked about, and why we've talked about Apple sort of stalling. You mentioned, I can't remember what term you were. It was a pretty harsh term. I don't know if I agreed with it, but there's been no EPS growth over the last 3 years with Apple, I believe. And so that's earnings per share. And what you like to see is a steady increase in earnings per share, or for example, net profit margin or share book value growth. You want to see a steady growth in some of these things for companies that are giant companies that have been around for a long time. Are different than companies like, for example, Palantir, who just became profitable, who just actually it was a negative. They had no EPS until 1 or 2 quarters ago. So you can't use some of the same metrics to value, for example, a software company or a very new company until they become profitable and they skyrocket. Amazon wasn't profitable in the very beginning, right?
yeah.
So
And
yeah, go ahead.
yeah, so Apple, you actually flipped it on its head. So Apple has had slightly negative revenue growth over the past year, but they've had 9% EPS growth. And we went back to that fact about Apple that they're buying back stock to artificially inflate their EPS growth. So I do think some of these other metrics are useful when you have special situations like Apple kind of cheating on the whole EPS growth.
That could be a little. You're assuming that that's exactly why they're doing it. I'm not saying that
No,
is
everyone
one
knows
reason.
that. I mean, everyone knows that. You buy back shares to increase your EPS growth. That's why you do it. I mean, yeah, and I mean, I don't think there's. I've heard that said a million times, and I agree. I don't think there's a whole lot of other reasons to buy back shares other than to reduce the float, boost EPS. Yeah, so if you reduce the float, technically for every dollar of a stock that you buy, it goes up a little bit more when there's a lower amount of shares available than if there was a higher amount of shares available. But it also affects EPS.
Some other reasons why. However, you're probably right. On that, I'll say probably. But one of the things we're talking about is you can't necessarily evaluate new companies or companies early on in a phase. Um, in certain instances, you can only sort of look at, there may be other financial metrics to go ahead and look at. When you go on their website, these companies, well, actually, you can download PDFs of their financials. They usually have them on their website. You can download them. They'll have their last earnings call as well, and then you can listen to them. And so these are three that, if you want to be aggressive, especially in an AI play, and you don't want to just buy some of the big name players that may be sort of being chased right now prior to a pullback. For example, Nvidia, we may see a little bit of a pullback, to even somewhere around, it's like they're 40% over their 50-day moving average right now. You can look at some of these other companies and get in the game a little bit earlier than they're reported on CNBC by keeping these on your radar, putting them on your watch list, watching in July when their earnings reports coming out, and then deciding to invest in them. Not to mention, a lot of them are cheaper than buying a $2,000 Broadcom stock when you're buying something that's $4 a share or $10 a share or even $140 a share. And so not everybody's going to have $3,000 to invest in a stock. And so they may have $100. And you may say, okay, I'll buy $100 worth of Ace Tech or ASX. So put these stock tickers on: Coherent, ACLS, ASX. Follow them along closely. They're all build out phase AI plays.
Yeah, our sister podcast, Shipstock Investor, they did a segment on Coherent and ACLS. And I think it was ACLS where they said it was going to be in their small cap basket. So instead of taking a large position in ACLS, since it's such a small company, they consider it a small cap and they just have a little bit of it. So their strategy for buying small caps is to pretty much hold a basket of small caps rather than saying, okay, I like this small cap, I'm going to take a significant position in it and hope it goes way up. They instead buy a basket and put it all together, and they might reduce their lottery effect. They might reduce the ability to get rich off of one small cap, but in their opinion, it has a better overall risk versus reward profile.
There's something true in that. I mean, so a lot of times your big winners wipe out a lot of your big losers.
Yeah, let me tell you what I've been thinking about recently. So you talk about big winners wiping out big losers. I'm concerned that in AI, we kind of already know who the big winners are. I just sold my Nano X. I'm considering selling my AISP. These small caps that we covered earlier on, Nano X, AISP, and SoundHound have been significant underperformers. We know that all small caps have, just due to interest rates staying higher for longer. But in general, I feel like we kind of know who the big AI small cap winners are. And that's going to be Anthropic, OpenAI, Databricks. Maybe you could throw something like Figure AI in there, but these companies are all private. So we already know who the big small cap AI companies are, and they're private, and we're waiting for them to come public. So why am I buying these obscure public stocks that pretty much used a IPO as a fundraiser and don't necessarily have much of a future? I'm not sure that's the best strategy. I rather wait for them to become public.
Right now, it seems that it's almost a rotation of the money that's in, for example, Nvidia. People will just kind of, or some of these mutual funds will start to take their profits and the volume sellers will go up, and then they'll just rotate some of their money into companies like Amazon and Meta. Meta right now is sort of set up to this 500 level. It dipped down for no really great reason after earnings to like 450. I, full disclosure, own a large position in Meta. And then now it's gone up to sort of 500, stabilized, and it's formed this sort of handle. I mean, Meta's setting up very nicely. And then we've seen quite a bit of a pullback with some reverse selling with NVIDIA. And I kind of expect NVIDIA to pull back over the next couple of weeks. I just think that it has to. I don't think NVIDIA can keep going up like it is, but we've seen sort of a rotation with the money along some of these big players. When an index like IWM or the Russell 2000 has really struggled. It's just the money seems to be staying in the big name players or rotating through the big name players right now.
Yeah, it'll be interesting to see what happens this week. So last Friday was triple witching. It's kind of unexpected. We'd have a bit of a sell-off. And I've also heard a few people say that we might have some headwinds this coming week. Now, apparently, statistically, July, the first couple weeks of July are almost always good. And apparently, July is usually a pretty good month for the stock market. Also, election years are pretty good. So we do have some positive tailwinds that I think may help us. But yeah, the market has run up so hard and so fast, so quick. I hear nonstop on CNBC, hey, it's time for a pullback. Usually, when everyone wants the pullback, market's just a bunch of people wanting things, right? Or not wanting things. Usually, when enough people are saying they want something to happen, it's going to happen. It's already started happening over the last 2 days. My concern is that if we continue to get these high jobless claim numbers, we could have an actual narrative for a pullback. And if we have a real narrative for a pullback, other than we just need a pullback, then that could drive a more significant sell-off. But that's a wait and see thing. We have to see the data on employment.
Got to wait and see. The market's looking for a reason, right? Last week, when you put on a weekly chart, it's kind of a good overall picture of things. And we essentially traded the exact same. It was like the open on, I think on Monday was the close on Friday. So it was just straight up, nothing really happened. However, there was sort of this downside reversal and kind of a rotation in the money. And like I said, companies like Meta and Amazon looking pretty good right now, where a company like Nvidia, people started selling off, maybe taking a little bit of the profits. I really think the market's just looking for an excuse to pull back to like the 21-day or 50-day, but I don't think that the inflationary index is going to give them that. I do think that the market is really pricing in at least one rate cut. So if the one rate cut doesn't come, which I highly suspect that if the Fed is doing the right thing, I do not think they're going to cut. But we already saw, I think Nancy Pelosi was sending a letter to the Fed like, hey, by the way, the American people are hurting. Please cut rates, something to that effect to Jerome Powell. So
Elizabeth Warren has been the big one trumpeting that. I think Warren feels like it's going to help the Democrats' chance in the November elections, not just presidential, but other elections, if we get this big stock market boost from one cut. But I don't know if we actually will get a big stock market boost from one cut. Now, the only thing I would say is there may be a secondary effect. So supposedly, as soon as they start cutting rates, even a small cut, maybe a 25 basis point cut, we're going to get rates dropping drastically, especially the short end of the curve. So like the 6-month, 1-year rate is going to drop a lot more than the 10-year rates. At that point, if you're not making as much in your cash, if you're not making as much in your, let's say, Robinhood, money market, cash account, then at that point, you may be tempted to deploy it into stocks, including dividend stocks. So yeah, I think it will have a bit of a bump, but with only a tiny cut, it's not going to be as drastic as an effect as if they're drastically cutting rates. The only chance they're going to drastically cut rates would be if the economy is in trouble. And then at that point, the stock market is in trouble, regardless of whether or not they're cutting rates. So it's kind of a double-edged sword at that point. But yeah, every time I think we're going to have a 23-minute podcast, it still winds up being 33 minutes. But good episode. We covered a lot of great stuff. You have anything else to add, Kai?
no, what are we going to talk about next time? We should come up with something I wonder if there's other, last week we talked about Broadcom, but the dividend is 1.2%. Maybe we should find another AI play out there with a significant dividend where most aren't significant. We have gone over energy stocks and those carry a significant dividend, which is why I've held a position in a lot of the energy stocks from the very beginning, sort of as a hedge. If rates did come down, then I would see a lot of these potential players that are just hold their money in money market funds that would go ahead and deploy those. Especially utilities tend to be a little bit more of a defense play sometimes. So yeah, great episode. Thanks for talking to you. Enjoyed. Excellent intro.
Yeah,
Kudos,
I was going to
James.
ask you. You didn't give any credit for the new intro. By the way, there's going to be a matching outro. It just takes some time to, it's a 3 or 4 hour edit. So to find those 3 or 4 hours for the outro, but the matching outro is eventually coming and it will be almost as sexy as the intro.
Until you're doing the Dougie on the intro, it's not going to be completely perfect. So once you do the Dougie or something, then we're
pretty much doing the Dougie on the intro. The intro is pretty cool. We're on all these TV screens. It's pretty much, it's up to par with doing the Dougie, in my opinion.
Please leave us comments, questions, dislikes, or like. We love the comments. So thanks for whoever left that comment out there.
Yeah, we're not specifically requesting dislikes, but if they come along, we'll cope. We'll deal with them one at a time. But yeah, thanks for listening to our show. Please give us a rating or review, or on YouTube a like or comment. And we'll be back in the next episode to cover more AI stocks. You can find all our holdings and trades at investingintel.ai. Thanks so much, Kai.
Thanks, James.